we started with the three concepts of what is balance sheet, what is income statement, and what is cash flow. So basically, as as taught in the class also, balance sheet is a snapshot of a business position as on a particular date, which specifically states how much assets has the business got and how much liabilities has it got. Okay, and whereas income statement talks about how much revenues were made during the period and what was the expenditure that was made to make that revenue. And cash flow is one of the most important components, which talks about how much cash came in and how much cash went out. So just to test your understanding, guys, I mean Rajiv, Anirudh, and Priya, if you could, one of you guys, if you could explain what are some of the examples of balance sheet items. Yeah, it's a balance sheet item. Yeah, yeah, and what else?
Fixed asset, current assets,
Fixed at
long-term
fixed
loans.
fixed
Yeah, yeah,
fixed
yeah.
in the balance sheet asset side will be fixed at furniture and fixtures, cash at bank, cash in hand, and debtors. These are
Yes.
the asset components.
These are very good examples. And what about the income statement? Any examples of income statement items?
Company's expense kind
Debts,
of.
Huh?
Company's expense.
Expense, revenues.
account receivables, trade
No,
debtors.
no. Account receivable is a balance sheet item because that's more of how much money you need to collect from your customers. So it's a kind of a position, right? So if you look at if you look at these things like when fixed assets, how much of assets that I have, it's more of a position, right? Similarly, how much bank loan do I have? It's a position, right? Whereas if you take revenue is not a position. Revenue is how much you have earned, right? Similarly, salary or expenditure is how much you have spent actually, right? It's not a position, where rather it's a spend. Another example that I was giving yesterday was, imagine that you have purchased a car, okay, motor car, like any car that you're buying, and you will fill it with petrol, right? So far as a business is concerned, any expenditure for buying an asset, like whatever, the car is more of an asset, which is a balance sheet item, whereas the petrol that you're filling on for the day-to-day needs is more of an expenditure, which is an income statement item. So any expenditure that you make to bring an asset, yeah, is a balance sheet item. Whereas an expenditure that you incur to cover up for the day-to-day running of your business is your income statement item. Yeah, is that clear?
Clear.
Now, cash flow. Going back to cash flow. Cash flow. There could be. There are two elements. One is how much cash came in. Like for example, capital has been contributed, so it's cash in, right? Whereas when you say salary paid, is it cash in or cash out?
For company it
What?
is cash out. For us it is cash in.
The most important thing, as I mentioned, we are looking at from a company's lens. Okay? The business.
Okay.
Yeah, no, I'm just trying to make things clearer for you guys. What about the salary paid to the the owners, like the management remuneration? Is it a cash in or cash out?
It is cash.
Cash out, cash out.
Cash out only, right?
Cash out. Yeah. What about when you're selling goods on credit? Is it cash in or cash out? When you're
Cash out.
selling goods credit, when you're selling goods on credit, is it
Cash out.
huh?
Cash in.
Cash out.
It should be cash in, right? Cash in.
Neither cash in nor cash out. There is no cash involved there because you sold it on credit.
Yeah, right, right.
And when the customer pays you at a later point in time, that becomes cash in.
Hmm.
Yeah.
Okay. Okay.
And that
Okay.
will be cash out for the creditor. Sorry, for the customer. Yeah. Okay, so these were the basic things that we discussed yesterday, and then we started with an illustration by examining a few transactions, assuming that we are setting up a new business. So we started the scenario. Maushmi, you have any questions till now before we get into this example?
No, I'm good.
Okay,
She's
so
expert here.
yeah. She is very quick to grasp things also. So assume that a promoter or an entrepreneur has contributed capital by pumping money into the company's bank account. So this is how it will reflect in the balance sheet and in the cash flow. So one of you guys, Anirudh or Rajiv or Priya, can you just explain how this has been done? So that I can also know that whether you understood it properly.
I was not there by then.
Huh? So you didn't get it. Okay, fine. Then what about Anirudh?
I was not there till this. As you were explaining.
You are not there.
No.
Okay, then Priya, go for it, man. Our commerce expert.
No, actually, I've already understood, but I cannot explain like you. It will be better if you can explain, then I can also recall it again.
Okay, fine. Fine. First, wait. First, you try to analyze a transaction, identify what are the two elements in that transaction, because it's all about double entry system of bookkeeping where there will be two items, one on the debit and one on the credit, but we are not concerned about debits and credits. But at least try to understand what are the two elements in this transaction. In the first one. Exactly. So that's what happened was the owner has contributed his capital. So the owner's fund or the capital, we will record 1,000 in the liability section of the balance sheet. Because so far as a business is concerned, this money has to be repaid to the owner at some point in time, right? At the same time, company's bank account balance increased by 1,000, right? Because he gave cash, right, and it was deposited in company's bank account, and bank account, any bank balance lying in their books is an asset for them. It is a current asset. So that's why we have 1,000 in the balance sheet as an asset. If you look at the cash flow, opening balance was 0 because company was not even set up, and then there was a cash inflow of 1,000 from the promoter. So the closing balance is 1,000. This is what we are seeing here as well. Clear?
And
Yes.
another thing, Vilas, what I exactly want to say, basically in that context, that in any case, if company's current asset is more than current liabilities, which we actually call the current ratio, current asset divided by current liabilities, then we have to understand the company's position is good in this market, right?
True. So that is called working capital ratio. So basically,
Exactly. This is the
what is
thing.
your
Yes.
current asset versus your current liabilities? Because as we mentioned before, these fixed assets, owners fund, long-term liabilities, these are all long-term assets and liabilities. Whereas current assets and current liabilities is how effectively you manage your working capital for the day-to-day running of the organization. So if this assuming
And
that this
In
current
addition to that, I just want to say that the current asset is to current liabilities. The ratio has to be always 2:1.
why do you say that it has always to be 2:1?
Basically, if the asset is more than the liabilities in the double of liabilities, then the position of the company is good in the market. So
The
that's
ideal
why the
scenario you're
ratio
saying,
I'm
right?
talking about 2:1. I'm telling.
See, it can be contested, Priya. Maybe you know better than me because you are working in a bank, right? Maybe you are right. But what I have seen from my experience is fine. 1.5 to 2 is fine. Yeah. But anything just above 2 means it's too much of current assets. You are not effectively deploying your working capital.
That is also true. That is also true.
Yeah.
That is
But
also
but
true.
but as you said, in any case, your current assets has always current assets should always be greater than your current liabilities.
Exactly.
Otherwise, the implication is that You are selling goods on credit. You are buying goods on credit. You are selling goods on credit. But you need to
Like
pay your suppliers.
in that case,
Hmm.
yeah.
In that case,
In that case, whenever you are investing into any stocks or the shares in market, then in case of any new startup, in any new company, you have to go through the balance sheet of the company first. Then you can understand what is the position of the company into the markets, whether you should go for investment or not. That totally depends upon the balance sheet. Basically, in banking, what we are doing, whenever we are collecting the documents from any clients or any entity, we first go through the P&L. After that, we are going through the balance sheet. If the balance sheet and a PL is good, more, then we can go for the acquiring that company. But so many things also depends on that, like credit rating of the company. Those things comes later. This is an addition, not relevant to these topics. I have just told you. You
no, no, but
for
that's
your
really good.
for your knowledge, that not for
That's really
Vilas but rest others.
no, no. That's really good because then people know what is the significance of this current assets, right? As we mentioned, yeah. What is the significance of current assets and how is it connected with current liabilities when we assess the working capital? Yeah. Anyway, so first scenario is clear. Let's move on to the second scenario. So, so imagine now what you have is you have 1,000 rupees in your bank account from your owner. Yeah, with that 1,000 rupees, what you're going to do now is the business is purchasing some inventory or stock of some retail items, and they want to trade those retail items to some customers. So, so Anirudh, again, can you just try to explain what are the two elements of this transaction? No, no, you are partially correct. You are correct in the first aspect. Here, two elements are there. One is stock, and the other one is cash out. Cash, right? Cash went out. In the previous one,
Okay.
we saw cash coming in. Here, cash went out. So that's why
Okay.
you're showing that in the cash flow, your opening balance was 1,000 from the capital that you got from the owner, and from there you are deducting the cash outflow for the stock purchase that you made. So your cash balance becomes zero, but at the same time, your stock increases to 1,000.
Correct. Clear.
Yeah. Motion clear? Clear till now?
Yeah, yeah, yeah,
Sure,
yeah.
sure.
I'm asking Maushmi. Is she still on the call?
Yes, I am here, Vilas.
She will be
Ah,
there, but she is having her working hour as well. I think.
okay.
Sorry.
So I think you are working parallelly, right? As well. You
Yeah,
have
I
your
got a
working hour
call
till
from
10.
my manager actually in between, so I had.
I know you are working till 10. That's why mostly she will be on mute, but she's understanding.
Yeah, and by the way, just FYI, although this is not a brag, but I am from BCom background, so I get some of these pieces.
Ah, okay,
Ah,
okay.
okay.
So
Okay.
just
Good.
FYI, it's not like completely new for me, but yeah, obviously I'm not immersed in it as much as you guys, so not really in the know of things, but yeah, I majorly understand P&L, balance sheet structure, etc.
Ah, okay. Then it's fine. Then it's a matter of we are testing just Anirudh. Okay.
Yeah,
No,
yeah.
no, no, not him. He's again from finance background. I'm not.
No, I'm not from finance background at all. It's BCom, so you have to sit and build all of this.
No,
You
no,
have
no,
to
no.
sit and create
I was
P&L,
I
and
was
you have to
talking
sit
about
and create balance sheets.
I was talking about Anirudh. He is MBA in finance. That's why I was saying.
Ah, right. So I have.
Okay, fine. Let's move on. Uh,
Nice.
yeah. Third one is okay. Third scenario is where we have purchased this inventory now. We have a stock of 1,000 rupees, and we are selling the stock at a margin of 20%. So Anirudh, again, over to you. Yeah. Yeah. So how we get to that net profit? Yeah. Beautiful. Beautiful. Just to elaborate on that, again, if you look at the two elements of this transaction, one was you sold sales, right? Then the other one was your cash in, which Anirudh explained. Now there is another element which I explained yesterday was whenever you are selling, your inventory balance now goes down, right? So that coming down is being put in as an expenditure in your income statement. So this 1,000 is nothing but the stock reduction, right? You are showing the stock reduction by expensing it out in the income statement so that the difference between the purchase price and the selling price will become the margin, and this margin belongs to the owner. That's why the 200 has been added to the owner's fund. Okay, clear?
Yes.
Now, fourth scenario is based on the previous transactions. The company now decided that, okay, let me buy some goods this time on credit, okay, and then try to trade it. So they acquired further inventory for rupees 3,000, but on credit. So what happens here? Rajiv, you want to try? Yeah, up to you.
No cash is involved.
Yeah.
No cash is involved first.
So first try to understand, first try to identify what are the two elements in this transaction. That is very key. Yes. Yes. Second one, act. So credit from creditors, right? Credit from your supplier. Exactly, exactly. So that's why you see here, stock increased, yeah, from 0 to 3,000. Same time, creditors balance liability also increased by 3,000 because you need to pay them. There was no change in the cash flow, no cash transaction was involved, nothing happened in the income statement also. Yeah, that's happened on scenario number 4. Scenario number 5 is out of the goods that we have purchased for 3,000 as credit from the supplier, we sold portion of it, which is worth 2,000 at a margin of 25%. And how this was sold was 50% on cash and 50% on credit. So this is a bit of a complicated scenario. I think Anirudh will be in a better position to explain. Yeah. Yeah. Yes. Yes. The current liabilities, how do you say about everything was correct except the current liabilities. So let me explain it again. Okay. So your total sales, now that's no change, right? There is no change over there. No change on that from this transaction. There was no change over there. So what happened here was goods worth 2,000. When you're saying you are selling it at a margin of 25%, meaning that your sales is 2,500. That sales you directly record it in your income statement as sales. Yeah. Then cash in is a cash flow item, so it goes to cash flow. Credit goes to your receivables or your customer balances. And then you made a profit of 500, so that goes into the owner fund. So it was 1,200 before, so now it has become 1,700. Rajiv, Rajiv, clear? Rajiv, I think Rajiv,
I think Rajiv may be busy in calls.
Uh,
maybe,
the
maybe
cash sale went into the cash flow statement, right?
Yes, cash sale went into the cash flow statement because there was cash involved. So your opening cash balance was 1,200, and then there is a further inflow from the sale transaction. So your closing balance was 2,450. That went into the balance sheet as a current asset.
Yeah. And this 3,000 was all a part of your stock.
No, 3,000. No, 3,000 was
No.
your original stock. From there, you are deducting this 2,000 because you have sold those goods, right? So that
Okay.
2,000
Yeah.
got deducted in the
So from
expenditure.
stock, it 3,000 we reduced, and then that 1,250 out of that got credited to receivables. 1,250 went into the cash part, and
Yes,
then 500 got added to as a part
owners,
of the profit made. So it went into the owner's fund.
owners fund. And then stock was 3,000. You sold stock worth 2,000. So, and you recorded it here. The balance is 1,000.
Correct.
Okay. Rajiv, are you back?
राजीव क्या आप हमें सुन सकते हैं? राजीव dropped.
Rajiv left. Okay.
Hello.
Yeah.
Hello.
Yeah,
Yeah, I was
Rajiv.
there. I was there actually. I was able to hear. I'm not sure why it was not audible to you guys.
No,
Okay.
आपकी आवाज नहीं है.
But Rajiv, it's clear now, right?
Till now it's clear. Yep.
Okay. Now the next scenario, I think yesterday when we were having our discussion yesterday, five, right? Now we start with scenario number 6. Yeah, it's a bit of a slightly again bit more complicated than the before one scenario because huh? Oh, I didn't know that. Okay, I was focusing on the screen. Okay, I didn't know that.
Quiet. She can't hear you guys. 1 second, I have to
Hello.
disconnect my headphones. 1 second. মিষ্টু ঠিক করে কথা বলো প্লিজ. Say hi. কি নাম বলো? নাম বলো? বৈষ্ণবী.
Ah, nice name, nice name.
It's
How
her
old is she?
bedtime and my study time. So yeah, we compromise like this.
How old is she?
She's 8. Mr. Quiet. Yeah. And I have another one here.
Oh,
Yeah, class 3. That's right, Anirudh. Mr. Quiet and sleep and study.
oh, my daughter is.
With one action, I just derailed the whole class.
No, it's fine.
अगर मैं नहीं पढ़ सकती मैं किसी को नहीं पढ़ने दूंगी. Please stop it. Okay, I'll switch off my camera so that others can focus at least. Mr. Good night, bolo. Good night. Good night, bolo.
Good night,
Good night.
Okay, so let's get back to here. I didn't know that the camera was switched on. Then when Anirudh was saying, I didn't understand in the first place. Okay, I thought that he wanted me to switch on my camera, but I'm on a different screen, so that's why I can't switch on my camera. So yeah, so now this sixth scenario is where you remember there were some creditors of 3,000 rupees for which you brought stock on credit, right? Now those creditors are putting pressure on the business, yeah, to repay that amount, yeah. But what you observe here, what is the cash balance that we have from till now is only 2,450, and then you need to pay 3,000. So you are short of funds, right? So from cash you can pay only 2,450. So remaining we are assuming that they are buying from they are taking an overdraft facility from a bank. See, now, see, it could happen anyway. It could happen either way. Like sometimes business will say that I will not pay you in full, I will pay half. Or sometimes business might say if the creditor is too powerful, they will say, okay, let me settle it, let me get a bank loan, short-term loan, or a bank overdraft and settle it. So this is what happened here. So 3,000 needed to be paid from cash. They had this 2,450. Remaining, they had to source it through a bank loan or a bank overdraft. So this is exactly what happened. So sorry, this is no change over here. This is changed.
First of all, what is NG? So OD would typically attract an interest, right, Vilas? So that interest will then show up in your income statement as a expenditure.
Yeah, I didn't get into that. I didn't get into that complication. You are right, but I didn't want to confuse the other people. So I have an interest portion coming on the bank loan at a later stage. Okay, I will explain that at that point.
Yeah, thank you.
Now, what happened was you had to get a bank over. So dues had to be paid. So creditors is one aspect of the transaction. So you paid them through cash and through bank overdraft. So if you look at the cash flow statement, you had an opening balance of 2,450 and you had a cash outflow of 2,450. So your net cash is zero. Remaining, you've sourced it through a bank overdraft. So that bank overdraft is a liability and your creditors were paid in full, so your creditors balance will become zero because you paid them, right? So you paid the creditors of 3,000, so this balance of 3,000 became zero, yeah. And then your bank overdraft, you had to secure a liability from the bank, so your liability increased, and your cash was completely worn out because you paid the creditors from your cash pool also.
Yep.
Clear?
Yep. Clear.
Now next thing, yeah. Now next thing, what happens is, so now see usually the bank overdraft or a short-term working capital loan from bank is usually subject to a very tight timeline. So bank might say that I will give an overdraft facility, but you need to close it at the earliest. Yeah, this is how it happens. So basically, that's what I explained in scenario number 7. The business had to honor this overdraft pretty quickly. Otherwise, the bank will, mark this customer as a very bad customer, or it's going to ultimately affect the banking relationship. So what the company did, they put pressure on their credit customers. Remember, we had sold some goods on credit, right? So this 1,250 was sold on credit before, right? So they said they started putting pressure on those credit customers, and then they had paid based on that fallout from the company. Yeah. So how much was the collection from customer? It was 1,250, right? So this was due, right? So they collected 1,250 and then they settled the bank overdraft. So bank overdraft became zero because it was settled in full from the cash collected from the customer. Your cash balance, what happened was opening balance was zero. Remember, we had paid it in full to the supplier before. So it was zero before. Now cash inflow came in as collection from the credit customer of 1,250. Out of which you gave 550 to the bank towards the overdraft closure. So your net balance is 700.
That's fine.
Yeah.
Yep. Clear.
Clear. Okay.
And here you were saying like Moshe was saying like we're not considering interest over here. If interest would happen, there, then definitely over and above 550 you would have to pay, right?
Definitely. That would have been, it would have been an expenditure in your income statement,
Right.
but I didn't
Right.
not to
Got
confuse further.
Got it.
Yeah.
Got it.
Now, scenario number 7, we move on to scenario number 8. But just take a position here. Your owner fund was 1,700. Your bank OD was zero. Your creditors were zero. You had a cash balance of 700, and you had a stock of 1,000. Okay, this is the business position. Now, what happened was business started smelling a lot of market potential for the item that they were selling. So they became greedy. Okay. So instead of procuring them from the suppliers, they thought of manufacturing it by themselves. Yeah. For this, they had to buy a machinery. Yeah. A machinery is costly, right? I mean, you cannot buy it at the cost of the stock, right? It's not a small amount, right? So machinery they had to procure. But if you look at the cash position, they had zero cash, right? Like very minimal cash only, right? So what they had to do, they had to procure a machinery on bank loan, yeah, on a long-term bank loan. So these kind of loans, this is not a working capital loan. When you're buying a fixed asset, when you're buying a large asset, it will be through a long-term loan, right? Like similarly, like the car loans that we're taking, it's a long-term loan, right? You repay it over a period of 3 years, 5 years, 7 years, like that, right? So similarly, they decided to purchase a machinery on a long-term bank loan. Now, when you go to the bank will never finance 100%, right? Bank will say, I will contribute, I will finance you 80%, right? Rest is your cash down, right? So similarly, here, since they didn't have enough cash, promoters had to contribute that balance. So assuming that the cost of the machinery is 10,000 rupees, owners had to contribute towards the cash down of 20%, which is 2,000, and then the bank financed the rest for 8,000. The scenario is clear before we get into the treatment.
Yep. Yep.
So let's look at what happened. The cost of this machinery, 10,000, is what does it represent? It's a fixed asset, right? So that's
Yep.
why the balance sheet, your assets will increase by 10,000. Because this asset belongs to you, right? So that is business asset. So that's why fixed assets increase by 10,000, or we call it as fixed asset value is 10,000. Yeah. Then owner's contribution. Yeah. How did it happen? Was owner's capital was 1,700 before. Now he has contributed further 2,000. So that became 3,700. Yeah. Bank finance for the 8,000 as a long-term loan. So that become a long-term liability of 8,000. Yeah. And then the cash flow position, opening balance was 700. Promoter gave in 2,000. At the same time, you paid the bank as cash down. So there is actually literally no change in the cash balance. Yeah.
Perfect. Yep.
Yeah, that's why usually what happens in these kinds of loan is bank will not pay you actually. Bank will pay directly to the supplier. So it's not might not even come in your bank account. That's why I put it like that. But we can also show it. I mean, we can also show it like a cash inflow of 8,000, yeah, and a cash outflow of 8,000 also. Or total 10,000, 10,000 as both cash inflow and cash outflow. Because I didn't want to overcomplicate things, because if you strictly look at the cash flow statements of the companies, you will find three major cash in and cash out under three buckets. One is cash flow from operations, yeah, which is your core operations of sales and the expenditure. Then there is something called cash flow from financing, yeah, which is bank loans. You are taking bank loans, you are repaying bank loans, yeah. And the third one is the investment. If you are investing somewhere in shares or another business, that will also come there. But I didn't go to that level of details. Probably, maybe at a later stage, our professor will teach that point in time. I can explain that. But now, if I explain all those things, your conceptual understanding might get confusing. That's why I didn't. That's it. Yeah.
Sure.
So this scenario is clear, right? So then what happened was, scenario number 9, the company had actually started producing goods with that machinery which they bought, and they produced the first lot of goods which was sold, including the stock from the old purchases. So assume that the cost of the new goods produced with the machinery was 500. You had the value of existing stock, yeah, and you assume, so this is 1,500, right? And you assume a 20% margin, so your sales value will be 1,800, yeah. And the cost of goods sold is the value of the stock that was produced plus whatever value was lying in your books, right? So that is 1,500. So what will happen is your 1,800 will straight away recognized in your revenue income statement as revenue, and your cost of goods sold, which is 500 plus 1,000, will be your expenditure, and you made a profit of 300. So that 300 will be added to the owner fund. So 3,700 plus 300 will become 4,000, and then your stock will become zero because you didn't had any you didn't had any stock left now because whatever was there, you sold it. So became zero. Receivable, no change because this was made on cash transaction. And let's cash flow position. Opening balance of cash was 700 from before. You had a cash inflow coming from this 1800, and then you had a cash outflow of 500, and the total balance will become 2000. Yeah. Because why that cash outflow 500 is, in order for you to produce this quantity, not just the machinery is needed, right? You need raw materials to produce the machinery. You need labor, right? And you need electricity and everything, right? So you need to pay that. So assuming that we have paid for those, so that becomes a cash outflow. Otherwise, I could have added this as 500 in the creditors, but doesn't make sense. So that's why I put it under cash flow 500. So the closing balance of cash will be 2000 net, and that goes into the balance sheet as cash. Clear? Any questions here?
Yeah.
So if you look at the income statement here, yeah, I'm just now introducing the formal terms. So the revenue is 1800 minus COGS. COGS means cost of goods sold or the direct cost of selling that product, which is 1500. This is 500 from the expenses needed to produce that goods plus 1000 from your previous stock that you purchased from the supplier. So the 1500 is the cost of goods sold. Difference between your revenue and cost of goods sold is called gross profit, which is 300, right? And this represents, profit, your profit before you deduct the indirect cost. And this we always call it as gross margin or margin. Clear? Rajiv?
Clear. A lot is clear.
Yeah. Then scenario number 10. Now assume that, just 1 second, guys. Yeah. So assume that the company had also to pay the volume-based commission because it has made a lot of sales till now, right? And they had to pay the rent for the factory on which they installed the machinery. Yeah. So there are two expenses here. One is marketing cost, which is the commission, and the other one is the rent for the factory. So assume that the marketing cost was rupees 100 and the admin cost, which is rent, is 200. So they had to pay this, right? So what will happen is in your income statement. Let's look at the income statement first, then it will be clear for you. The revenue is what I have put now is till now I was just showing you individual scenarios, right? Now here onwards, I have put the income statement for the entire period, which is a culmination or your consolidation of all the sales that you made till date. Yeah, so you have this formula, right? So you have this one sale you had made for 1800, another sale you had made for 2500, and then the first sale that you made for 1200. So all these you are culminating and you are reporting it as your revenue. Cost of goods sold is similarly is a culmination of all the cost of goods sold that you made till now, and your total gross profit is 1000. From that gross profit, you deduct, because see, this is how it will be usually reported. These till here was for your understanding only. Okay. So, but now onwards, I've just put it formally in the way of an income statement. So that's why I consolidated everything. That's why I said it for the entire period. So the revenue is this one, cost of goods sold is 4500 and your gross profit is 1000, or your margin or your gross margin is 1000. From there, we are going to deduct the indirect expenses. One is marketing and selling expenses, another one is administration expenses of 100 and 200. And then if you deduct these two from 1000, what you get is called earnings before interest, taxation, depreciation, and amortization, of EBITDA. Yeah, this is nothing but your cash profit from your operations or your operations profit. Any question here on this? Yeah. Now let's look at what happened in the cash flow. You had a balance of 2000. You had to make these payments of 100 and 200. So your cash outflow was closing balance of 1700 of cash, and this became cash in 1700 here. Yeah. And your owner's fund was, previously how much was the owner's fund? It was 4000. Yeah. And now in owner's fund is nothing but the capital that was introduced. Let's look at the formula now, just to understand. He had first capital of 1000. Yeah. Then he further introduced a cap of 2000. Remember, for the bank loan, so that 1000 became 3000. Yeah. And then 3700 of EBITDA till date. That becomes 3700. Clear? See, from here onwards, everything is consolidated position so that you can better understand now. Till here, it was individual snapshots for you to understand. Clear? Scenario 10 is clear?
Yeah. Can you help me once again, please?
Okay.
Confusing.
Where was it confusing? Is it confusing here or the way in which I
Yeah. No. The rightmost segment. Yeah, that's the one.
Okay. So imagine, as I mentioned in the beginning of the class, right? Income statement is the profitable during the period, right? Or period till date, right? It's not a it's strictly not a snapshot, but what is the consolidation of all the transactions that has happened, right? So till here, I explained individual transactions and how it will impact the balance sheet, cash flow, and income statement. But now here onwards, I'm in consolidating everything into the income statement so that it becomes a formal statement rather than snapshots. So that's why when I said revenue, I took into consideration all the revenue that the company made till date. Yeah, assuming these were all daily transactions, Rajiv. Okay, assume these were all daily transactions.
Okay.
Business is not interested in knowing what happened on a daily basis. They would be interested to know on a consolidated basis at the end of the month, or at the end of a quarter, or at the end of the year, right? Assume that this is for that particular month. Okay, so business would be interested to know what is the total sales that I've made, which is nothing but the combination of all your revenues or all your sales till date, which was the combination of the daily sales. That's why 5,500.
Got it.
Got the concept?
Okay.
Yeah.
Yep.
Then similarly, cost of goods sold, I consolidated everything, and then I got a gross profit of 1,000, which is the difference between these two, which is
Difference of it.
yeah. And then I'm deducting the indirect expenditure, and then I'm getting EBITDA. EBITDA is the cash profit from your operations. Because everything till here was part of your cash operations, right?
1,000
Because
minus 300. That's what you're saying, right?
yeah, because all the charges that are hitting the income statement is cash based or credit based, but not non-cash, which you will see subsequently. Okay. Can we move on to scenario 11?
Sure.
Now, scenario 11 is where I'm introducing depreciation. So, tell me, what is your understanding of depreciation? Okay. But why do you need to account for depreciation? Exactly. This is the business explanation for depreciation. As Anirudh was mentioning, yeah. So I have a machine now. I have a machine or a furniture now. If I don't, and if I need to replenish for the business to run in the future, if I need to replenish that machinery in the future, I need fund, right? I need to accumulate fund from now onwards. Otherwise, what will happen if you don't deduct your depreciation from your net profit will be boosted, or it will show more, and then you will not have any fund. That fund would have now gone from business to the owner, which is not correct, right? That fund should remain in the business, right? So that's why we have to deduct depreciation from the income statement, or from the gross profit, or from the, before we arrive at the net profit, you need to deduct the depreciation. How that is being done? Is this concept clear? Because Anirudh was very clear. Is it clear to you, Rajiv?
Yeah,
Why do
not
you,
it. And yeah, I'm pretty clear, but my understanding is a bit different. But yes, more or less the same thing.
what is your understanding? Tell me.
Not understanding, I would say depreciation. If I consider, like, say for an example, I'm purchasing a house, okay, at this particular time, okay.
Hmm.
So say for an example, I'm purchasing it at a rate of 30 lakhs, and uh, after COVID comes in, and God forbid, I have to sell it again. So I'm selling it at 25 lakhs. So because of the recession in the real estate, so
Hmm.
that difference of 5 lakhs are considered to be depreciation kind of thing.
No,
Am I correct? Is
That's
it
no,
different?
loss,
that's
right?
That's
That's
loss.
yeah,
loss, right?
that's
Okay.
loss on sale. That's loss on
Okay.
sale. Yeah.
Depreciation is when you write off the useful life of a fixed good, fixed asset over a lifetime. So, for example, if it is 10 years life, you will gradually have to keep reducing that value, because when you
Okay.
sell it off, you will not get what you purchased it for. You will never get it, or you
Okay.
have to
Okay.
scrap it
Okay. Okay.
also. So,
Okay.
if you
Like
scrap
if
it,
I purchase a car kind of thing, right?
yeah, right. So it will, suppose 10 years is the lifetimes, and over the period of 10 years, slowly you will have to keep writing off that useful value, so that
Got
when
it.
at the end of 10 years you scrap it, it is not a complete loss, because if you keep showing it at cost price, then it
Mhm.
becomes a sudden loss for you when the value becomes zero. So
Got
So
it.
it shouldn't be that way. We have to account
exactly.
for future losses basically, and keep reserves for, and keep provision for future losses that way.
And
Okay.
another way of looking at depreciation is, see, assume that you are buying this machinery. See, in this case, let's take this case of this machinery. Yeah. So basically, your machinery value was 10,000, and you're planning to use it for a useful life of 40 years. 40 years is a bit more, bit,
Mhm.
on the higher side. Usually it's 10, 15 years only. Okay. Other than some specialized assets, but usually it's 10, 15 years max. Okay. But for this purpose of my calculations, I assume 40 years. Okay. So assume that you going to use this machinery for 40 years. Yeah. Now, if I don't put for depreciation now, you will have to account it against the sale that I made on year 40, right? Which is not correct. My
Okay.
cost of selling should also include the wear and tear of the machinery on a real time basis or on a yearly basis. This year, because I use this machinery for selling goods for 40 years, right? Producing and selling goods for 40 years. So at the
Yeah,
same time,
maintenance part, right?
yeah, maintenance and the wear and tear. It's not the maintenance cost, it's actually the wear and tear.
Mhm.
The machinery, as it gets old, you
Got it.
have a wear and tear on the machinery. So that you need to account with the sales. And as Maushini and Anirudh was saying, you cannot take a sudden hit on year 40, because the funds would have already gone to the owner's fund, which is wrong. This money actually has to be retained in the business. Otherwise, you will not have any that fund at the end of the year, at the end of year 40. That's why we
Got
are
it.
accounting for depreciation. So how we calculate depreciation is, you know we divide the we take the cost of the asset and divide it by what is the useful life. In this case, we assumed it at 40 years. So we had 10,000 divided by 40, which is 250 is the yearly depreciation charge.
Okay. Got it. Now it's clear. Yep.
Yeah. And sometimes what happens is, you know you assume that, okay, 10,000 worth of machinery, I'm selling it after 40 years. Sometimes I might be able to get 50 rupees as your scrap value. In that case, you deduct the scrap value or the salvage value from the cost of asset to arrive at the depreciation. So it's cost of asset minus salvage value divided by useful life. This is the formal definition of formal formula for depreciation. But this always the salvage value will be very less. Even if you don't consider, it's not going to make a big difference if you're talking about a long-term asset. Okay.
Okay.
So what happened was your previous EBITDA was 700, right, from the previous scenario. Now you are accounting for the depreciation. So the depreciation is 250. So your EBITDA is 700, your depreciation 250, and your earnings before EBIT is your earnings before interest and tax becomes 450. 700 minus 250, 450.
Clear. Yep.
Now you would see one thing. This earnings before interest and tax represents, your profit from operations after non-cash charge. Non-cash charge is the depreciation and amortization. It's a non-cash expenditure, but you're retaining it in the business for future purchase, future replacement of asset. Yeah, that's the non-cash charge of depreciation and amortization. And what is left is the earnings before your bank interest and your taxation. Now you would see here amortization. I put it as 0 just not to overcomplicate things. Okay. See, amortization is a scenario. Assume that you had developed a patent, or you have a license or a copyright. Yeah, yeah, for a particular item that you have built. Yeah, maybe you will have a. For example, you take the pharma companies, right? So pharma companies, one medicine, they might have a patent for 10 years, right? So that patent cost, you need to expense it over the life of the asset, or the life of the life of that particular patent. So that is one simple example of amortization. So if there was an amortization of there was such kind of an asset, you would have amortized that cost over a period of the useful life of that asset. But in this case, we assume that there is nothing of that sort. So I kept it at 0. Clear on amortization? I didn't want to overcomplicate things. Yeah.
Whatever you explained is clear.
Sorry, one more time on the amortization. Does it apply for intellectual property only, or?
It can apply for intellectual property. It can apply for any special licenses. It can apply for your special copyrights. All those things. If you're incurring an expenditure there, and if you have a tenure license for more than 1 year, you need to amortize it over the life of that particular license or your right.
So if you have like revenues coming out of that particular patent or royalties coming out of it, that goes in your normal income statement, right? Or does that have a special hit as well?
Exactly. That's why exactly, because what will happen is you pay a license fee, or you incur certain costs in bringing up that patent, right? Assume that was 10,000, but you will be using that patent over a period of 10 years to produce and sell that goods, right?
Correct.
So your sales for 10 years and your patent cost you just incurred in year 0 or year 1.
Yeah.
So how come it's possible that how you can match the sale with that patent? Only way is you book your sale as 1,000. In that same year, you book your 1/10 of your patent cost to 1,000.
Right.
And similarly, every year.
Prorating, basically, you're prorating your cost over a period of time that you get to use it.
Exactly. That is what exactly is happening in amortization.
Yeah.
Goodwill, yes. So goodwill, I'm not fully clear on the treatment of goodwill these days. So previously we used amortized goodwill, but after certain point in time, we never used to create goodwill, amortize it. I'm
But
not
how do
fully
you
clear on.
even quantify goodwill? And it's not like goodwill expires. Ideally, goodwill should grow until and unless you do some kind of a media blunder and then your goodwill just plummets. Otherwise, your overall goodwill should ideally grow over a year-on-year period. Like, how do you quantify it? How can you ask for goodwill? I don't understand
No,
this concept at all.
wait. Anirudh, goodwill usually happens when you're buying a business as a whole. Okay? when you're buying a business as a whole. Like for example, if the total
You're acquiring a brand. Inorganic, it's an inorganic growth when you're acquiring a brand, then you acquire the goodwill alongside of it.
correct. This is a $1 million question. I need to check that and get back to you. You had you had bowled an Yorker on me. Okay, I need to.
And you know, like Indian batsmen are not very much familiar to that. I remember
Even
Pakistan match.
you bowl like the Shaheen Afridi, yeah?
We
I
have
will
match
get
again on Sunday, right?
huh? Match is
Yeah,
on
match.
Sunday.
Let's see.
More Sundays to come, I think. I think there will be more India Park matches in the future. I think the next couple of months, yeah. I will get back to you on the treatment of goodwill later. Okay, I will check somebody on that. Okay, so now moving on to item number 12. Okay, the scenario number 12. Now we have reached to a situation where we have our before interest and taxation. Yeah. Now we need to assume a scenario where the company now needs to pay interest on the bank loan that took earlier for buying the machinery. Remember, 8,000 was the loan, right? Remember, we purchased a machinery for 8,000 from the bank.
80% by bank, 80% by bank, and 20% by own.
Exactly. 8,000 have to buy some. You have to pay some interest to the bank, right? So I'm assuming that forget. So I just applied interest. I divided it by 12 months. Ideally, it should be an year, but I didn't have sufficient funds in the balance sheet, so I just divided it by 12 and then put the interest cost as 30. Okay, and at the same time, the bank has also deducted the first installment of 200. Okay, assume that it's a value. It's not a formal computation. It's just an assumption. Okay, so you had made an interest payout, had made a EMI or your repayment note. So the repayment will get deducted as 200 from 8,000 becomes 7,800, and your cash flow position is opening balance 1,700 minus cash outflow, which is a combination of interest, first installment, and your net cash balance will become 1,400. If you look at the income statement, we have an earnings before interest and tax, and from here we will deduct only the interest portion. Okay? Because interest is an expense, whereas the bank loan repayment is not an expense, it's just a cash flow item. So that's why we are deducting only interest from earnings from income before interest and taxes. We get the sum of profit before tax 470. Is this clear? This scenario number 12. Now let's look at the scenario number 13. Okay? What is left? What you tell me what is left in the income statement now?
Is there? इंटेंशनली भी हो सकता है. रुक जा थोड़ा. रुक जा.
Okay. Now I'm clear, right?
Yeah.
So clear. So what is left after scenario number 12? You tell me from here, what expenditure is left?
IT.
IT, yeah, profit before tax. Now we need to understand what is profit after tax. So we need to account for the income tax. Yeah. So assuming that the corporate income tax rate was 30% on its profits. Yeah. Income tax is always applied on profits. Yeah. So we have the profit before taxation of 30% of 417, and you apply 30% on that, and your tax will be 125, and this has to be paid to the government. So it's a cash flow item, and also at the same time it's an expense also. So if you look at the cash flow, it will be cash outflow of 125, and your cash balance gets reduced and it gets reported. At the same time, you deduct the tax amount as an expenses from profit before tax, and you arrive at something called profit after tax of 292. This is what goes into your owner fund. 292 ultimately, whatever. So owner fund is a combination of equity plus your accumulated profit. So equity was 1000 before, right? And then he further contributed 2000, that became 3000. And then finally, what is his retained earnings is to, or retained earnings or accumulated profit or profit till date is 292. So that's why the owner's fund increased to 3292.
And then the problem is he has incurred 30% of tax.
Now you know.
On 417.
Anirudh, see how much money he invested. He invested 3,000, and then 10% he has made just on 4 5 transactions. Okay, think like that. Okay,
For 417, no one is going to harass you. It is for 417, it should be exempted. It's for the basic one, it's 10% actually. Flat 10%. Whatever is ठीक है हाँ
yes. So that will be part of your administration expenses. Okay, here.
yes देख देख अनिरुद्ध मैं क्लियर बोल रहा हूँ एक तू फ्रिज सर्विसिंग के लिए बुलाता है ना ठीक है देन उनका एक विजिट चार्ज होता है ठीक है यू आर टॉकिंग अबाउट दैट विजिट चार्ज that initial consultation you are talking about okay how's
Okay, I mean, anyway, so this is just a hypothetical example. Hopefully, he will make good money. Okay, but again, as I mentioned, he just procured some stock 4 5 times, rolled it, and made 10%. Okay, in a month or in a day. Okay, so hopefully his position will improve in the later stage. Okay, now then last question. Okay, this is the profit, right? And this is the owner's fund, right? So this, what is the total value of the owner's fund now? Correct. Now, how much dividend can the business pay to the owner? Maximum. So
in
now
addition
you
to this one right
wait. You have invested, Anirudh. You have invested money in the business. Yeah, as a shareholder. Assuming that it's a whether it be a private or a public company, you should get some returns, periodic returns, right? That is called dividend. Dividend. Yeah. In addition to your business growth and all, that's a different thing. Your market share value or whatever the worth of the net worth of the business has to grow up. That's fine. But as a minimum expectation, you will be expecting some cash back, right, as dividends. Now, what is the maximum amount of dividend that this company can pay to the share, back to the shareholder? Yeah, shareholder or the owner or the entrepreneur, whoever it is. You tell me how much is the maximum.
Addition होगा ना? I think it should be addition.
Additional where, from where you will source it? See, owner fund means it's in your liability in the balance sheet. When you're paying dividend, you get relieved of that. So you cannot pay anything more than this. But can I pay 3,000 as dividend? Why? Not just that. If you pay anything out of your capital, it becomes a capital erosion. And police will come to your house from company law board. Okay, they will send you police and arrest you. Okay,
Okay.
you are supposed to you are not supposed to erode the capital of the company. So that's why if you look here, if you split the owner's fund, if you look at the owner's fund, this is the initial capital. Remember, this is the initial capital of 1,000. Yeah, loan, cash down. So this is 3,000. This cannot be touched for dividend distribution because if you touch it, it becomes capital reduction. Capital reduction is a separate procedure. I'm not saying that it won't happen, but if it has to happen, it has got to be a separate procedure, and companies don't usually do capital erosion to pay out its dividend. Dividend is maximum 292, as Anirudh was mentioning. This is the accumulated profit. Maybe on year two, this 292 will become 500. Okay, that is the maximum amount that the company can pay as dividend. Yeah, but usually companies don't pay 100 as dividend. Maybe they will pay only 50% or 10%, whatever it may be, and the rest will be kept aside for future reserves. Yeah, so we can always say owner's fund is equal to equity plus general reserve. This is the term that you will keep on hearing: general reserve or accumulated profit plus special purpose reserves, or example capital reserve. Yeah, that is the owner fund. Okay, owner fund is a combination of equity plus your general reserve or accumulated profit, which is 292, plus special purpose reserve. But whatever qualifies for dividend is only from this general reserve.
Okay, clear.
Clear?
We need to remember terms, but it is clear.
Huh?
We need to remember terms, but it is clear.
Okay. So
The
I
reserves and provisions, part of it both come as a part of the balance sheet, right?
yes, all these are provisions, reserves. Sometimes what will happen. You will hear some other
They are
reserve.
appearing as a part of the liability part side of the
Exactly.
balance sheet, right?
Exactly.
Because they are being kept for a particular purpose, which is in future.
Exactly. Because you are reserving that portion from profit and you are retaining it in the business. Yeah.
Yeah.
See,
To cover a future loss or for a particular expense that you are anticipating in future.
Exactly.
So it's not really an asset because of that reason.
I will tell you what will happen if you don't keep aside those reserves. Okay, like depreciation reserve, right? So you have the profit of 292, right? And you have how much you have charged for depreciation was 50. Yeah. Assume that you didn't charge it in the P&L. Your general reserve or accumulated profit would have been 542, right? And you would have distributed this 542 as dividend to the shareholder. But on year 40, you don't have this 250 to buy this machinery, right? That's why you need to set aside. So this will become kind of a reserve, act as an indirect reserve because you are setting it off from your profit. Got it?
Yes.
Okay, I think this is enough. Probably, I will share this file again with you guys today because I made some minor corrections. So these formulas and all, like EBITDA, EBT, PBT, PAT and all, I have attached in another sheet. I think Saurabh provided this. This sheet, somebody was asking me yesterday on the treatment of sale tax versus income tax. I just kept it, and this is the info sheet. Okay, clear?
Okay, sure.
So I think we can stop now, and then I'm making some notes for the other ratios that was taught in the last class, and I will share it whenever it's ready.
Make
I
some
think
notes for exam as well.
same. Yeah. But this time I'm not making that much detailed notes because the PPTs that were shared by this professor was very good actually.
Yeah.